Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to talk about the upcoming Bank of England rate decision due to come out on Thursday the 18th at 12 noon UK time. I thought I would talk about this one because expectations and feelings around where interest rates have taken a big shift recently. And so I thought we'd break it all down, talk about how that could impact your mortgage, your savings, your investments in the stock market, all of those things. So let's get into it. Bank of England rate decision coming up on Thursday the 18th. All right, so first of all, why do interest rates matter so much and why is this such a big deal? Well, the reality is that interest rates are a tool used by central banks around the world, whether that's the Fed in the US, the ECB in Europe, or the Bank of England in the UK, a tool that they use to help control inflation and really try and stimulate economic growth or prevent the labor market from kind of melting down if people are losing their jobs. And that's really the main purpose of the central bank: control inflation and protect the labor market. But interest rates are something that affects all of us the world over. And you probably came to realize that in 2022 when interest rates shot up big time on the back of inflation, because it's a tool that they use to control inflation. So how does it really affect you and I in businesses up and down the country and around the world? Well, the main thing and the obvious one, of course, is borrowing costs. And the big one on that one is gonna be mortgages. Mortgage lenders around the UK typically set their mortgage rates based in and around the 10-year yield of government bonds known as gilts. Now, of course, when it comes to mortgages, your mortgage rate gets affected by what the Bank of England rate does. Because as it cuts interest rates or increases interest rates, your mortgage lender, if you're on a variable rate mortgage, of course, will pass that off onto you. So if interest rates stay the same, there would be no change. But of course, if they go up, it's going to cost you more money. And if they come down, it's going to save you some money on your monthly payment. And that money tends to go back into the economy in other areas. Hence why the central bank tends to cut rates when it needs to stimulate the economy. So interest rates and where they go and how they're set by the Bank of England is a big, big deal on all of us across the country, and businesses as well. Remember, they have loans of certain types that they use to run their business. So it affects everybody one way or another. Another way that interest rates will have an impact on the economy is through savings and savings returns that you would see in a bank account. Maybe you've got a cash ISA, although I hope you do not. If you've been watching my videos, there's many reasons to be invested as opposed to a cash ISA. But if you do, then it's likely to be affected by the movement in interest rates. But it's not just cash ISAs. Bank accounts of all sorts will be affected by the moves in the base rate set out by the Bank of England. Another way that interest rate moves like this will affect you is through your investments in the stock market. If you're invested in stocks in the UK or in other countries around the world, they are very, very susceptible to moves in interest rates for sure. So the reason why interest rates has such an impact on the stock market, well, it's really kind of twofold. One, as I mentioned a moment ago, it has a big impact on the economy overall because it affects the amount of money maybe that you have to spend or companies have to spend or hire or invest. But in another way, when it comes to investments, fund managers around the world will use interest rates as the sort of discount to take future earnings of a company, which is what they're investing in, and they discount that back to today's money, so the present value of those future earnings, and the discount rate is affected by interest rate movements because they tend to be used as the basis for this. And then you add on an equity risk premium. Not something you need to worry about too much, but basically when professional investors are looking to invest in a company, if interest rates goes up, then the value of those future earnings that they're looking to invest in today's money tends to go down. And that makes the stock less valuable today than it would be if interest rates did not move up. So the present value of future cash flows is really important in investing, and therefore stock markets tend to sell off when interest rates go up. It's more likely to happen in growth stocks and growth companies, things like technology. Some of the companies that we've seen move up so quickly over the last few years, they're a bit more susceptible, say, than value stocks. So it definitely has an impact on your investments. Okay, so where are we now with interest rates in the UK? Well, currently the base rate by the Bank of England is at 4%. And in August, they actually made a cut of 0.25%. And the feeling around that time and leading up to that cut was that interest rate cuts would likely to continue through the rest of 2025. But things changed big time when the UK inflation number came out recently, and it actually hit 3.8%. The Bank of England's target is 2% inflation. So up to 3.8%, this is now becoming a problem. And if inflation persists and stays higher, it means the Bank of England cannot cut rates like they were hoping to do. Because if you cut rates while inflation is going up, it's likely to increase inflation further. And this is a terrible thing for the economy, as we all know from 2022. The problem is the UK labour market is starting to weaken a little bit, and generally the Bank of England would like to be cutting interest rates when the job market weakens because it wants to stimulate growth and protects people's job. But it's now in a tough spot because if inflation is sticky and staying higher at 3.8%, then it makes it difficult for them to cut rates or risk inflation running rampant, and therefore the labour market could be more susceptible. This is known as stagflation, and it is a very difficult place for the central banks around the world to be. And there's something else that's entering the picture right now when it comes to the Bank of England interest rates throughout the UK that's worth talking about. And what we're seeing on the 30-year yield on the government bond, also known as gilts, we've seen it actually tick up recently to a 27-year high of around 5.7%. Why is this happening, and how is this going to impact interest rates in the future? Well, the reality is the 30-year yield doesn't impact too much on things like mortgages, savings, loans, and whatnot. It tends to be more the base rate and the 10-year government bond yield that does that. But it's a worrying sign when long-dated bonds like the 30 years start to move up, because what it's kind of saying here is that holders of UK government bonds are losing a little bit of confidence or have some concerns fiscally of the government and their decisions. Remember, we saw this big time in the mini budget that we had when Liz Truss was the Prime Minister. We actually saw it in April of this year in the US as well, and it was the rise of the 10-year yield in the US that forced Donald Trump to make a decision to put a pause on his tariffs. The bond market and interest rates are extremely, extremely powerful. I've seen this many times over my 20-year career in the markets. So this is something that's being talked about a lot more at the moment, and it's definitely worth keeping an eye on. It's also moved up because of inflation risks as well. That print I mentioned of 3.8% recently is also part of the reason why the 30-year is ticking up. Think about it. If you were lending your money to the government for a 30-year period, you would want to be compensated and factor in the risk of inflation over that period as well. So as inflation moves up, so do the yields, because you need to be compensated for holding it for 30 years. Let's watch what happens on Thursday when the interest rate decision is made and they're expected to hold at 4%, and see what happens to the 30-year yield at that time and over the next few weeks and months. It wasn't that long ago that the expectation was that interest rates would continue to head down throughout 2025. That does not appear to be the case right now. So the bottom line when it comes out on Thursday, borrowers are going to have to wait a bit longer to get any reprieve from their mortgage rates if they're on a variable rate. Savers are going to have the status quo, assuming they hold that 4%, and it gives you more time to lock in a higher rate on your savings if you choose to do it that way. Of course, I think you should be a long-term investor in the stock market, but for money you need up to 5 years, it should probably be in a bank account, and therefore you should get a better rate on it. And if you're an investor in the stock market, you need to watch not only on Thursday to hear what the rate decision actually is in the commentary by the Bank of England, but you also need to start paying more and more attention to the 30-year and in particular the 10-year government bond in the UK, because it may impact your investments. Same thing in the US, because this is not just happening in the UK as well. And of course, with the US economy being such a big part of the global economy, whatever happens there with their interest rates and their stock market are going to feed through to you people like you and I. Also, interest rate decisions have a big impact on the value of the currency. If interest rates goes up, it makes it more attractive to hold that currency. But if they go down, it makes it less attractive, so the currency tends to weaken. And if you watch my recent videos on investing in the US stock market through the S&P 500 in a pound-denominated fund, you will now know that currencies play a big role in your returns. If the pound weakens, all else being equal, then you can expect your VUSA, for example, the ETF to go up, or vice versa if the pound were to strengthen. So interest rates in the UK will have a big impact on your stock market investment, even if you're invested in the US in a non-hedged exchange traded fund like VUSA. But keep in mind, if you're a long-term investor, these sorts of things really shouldn't impact you too much in your day-to-day, and you should be a long-term investor. It's good to keep an eye on it. It's good to know what's going on. And it's, of course, great to be educated on all of this stuff because it impacts your day-to-day life so much. But being a long-term investor, pound cost averaging, dollar cost averaging into the stock market over time, you shouldn't worry too much about this stuff. I remember a story one time about somebody who had a charity lunch with Warren Buffett on the day that a US interest rate decision was coming out, exactly at the same time that they were having lunch. And when they interviewed this person after his lunch with Warren Buffett, he said one of his main takeaways was during that lunch, Warren Buffett had no idea and no cares whatsoever what the US Federal Reserve was going to announce for their interest rate decision that day. That's the mindset of a long-term investor. So take that with you. Always good to know, but don't get too wrapped up in what the actual number is because you're long-term investing and it shouldn't matter and these things will work themselves out. Well, that's my video on UK interest rates and the Bank of England decision coming out on Thursday. If you like the video, click on that like button. It helps get this video out to more people and help them learn more about this sort of thing. Subscribe to my channel if you haven't done so already and leave me a comment on anything that's on your mind regarding this or any other future videos that you'd like to see. If you want to see the video that I did on pound-dollar exchange rates and ETFs invested in the USA like VUSA, I'll put a link to that video right here so you can click on that and have a watch of that video. I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.